Okay, what's going on? We're going to be going through two macro pros and their theses and just trying to discern kind of probability, what's likely, when do we pay attention, and just how do we, conduct ourselves through what's going on this year. So Darius Dale's the first one. There's only a couple people I actually listen to when it comes to macro. Jeffrey Snyder is number one. Darius Dale is number two. And number three is Eric from EBP Research. They all have their own specialties. Macro Alf, he's kind of like he's in the top five. And then maybe Michael Guyad. Michael Guyad, he's kind of all over the place, but then when he's a critical thinker. So when he has something that's significant to share, I listen. So let's go ahead and jump in and see what they have to say.
Recession in the first half of 2023. I have to agree with them, but it scares me that so many of them suddenly agree with me. It makes me wonder if I've got it wrong. What do you think?
Great question, Eric. So, to our belief that we would take the other side of that. If we have sort of three core beliefs here at 42 Macro that we've been espousing in our research to our customers, I would say it's number one is that the U.S. economy is more resilient than the average investor realizes and is unlikely to enter a recession until the back half of the year at the earliest. Could be as late as Q4 of 23 or Q1 of next year. Number two, as a function of that core belief, the Fed will likely tighten more than what is currently priced into the market and be uncharacteristically reluctant to ease on the back end. And then number three, as a function of number two, the Fed tightening more and being reluctant to ease when they need to ease, it will likely cause the downturn, which will be, in our opinion, mostly timed in late 23 and in the early part of 2024. It'll likely cause that downturn to be worse than otherwise than consensus expects. There's
All right, that's basically it. In the beginning of the year, this matched my thesis for a second leg of inflation. And hey, we might get it. Yeah, I can't honestly tell you if we're going to get the second leg of inflation. I mean, in terms of PCE, it makes sense. We're going to get PCE reading coming this Thursday, Friday, but until that comes, I can't tell if I'm right or wrong. So that's kind of Darius Dale. So to summarize what he said, he thinks it's going to be Q3, around Q3, Q4, 2023 recession. And I've been posting charts, forecasts of just critical things that would relate to recession. 4-week Treasury forecast peaking in June. This is the 4-week Treasury. And then this is the PCE. He's tracking the PCE because it headlines the CPI. It has to do with consumption, expenditures. And then, so that's peaking in June. So it aligns with what he's saying. Delinquencies peaking in July. Reverse repo. We got two dates that we could look at. One is June, and another one is pretty much today or yesterday. And then unemployment peaking in June. Credit spreads hitting its widest point around June. So that's our forecasts match for the most part all of what Darius Dale has said on the broadest stroke. If we were to add some details, that reverse repo, that spike on the reverse repo, might have some nuance to it. Something we might have to pay attention to that I shared. I'm not going back to it. You could turn back the tape if you want. But that kind of brings us to Michael Guyad. He has a thesis, and we're going to listen to it right now.
I have around kind of short-term movements, April being high risk for correction.
So April, which is the month we're in right now, high risk for correction.
A melt up for the year, and then a credit event later in the year. And I would always go back and remind people that it's less about the Fed and it's more about the sequence of returns. The Fed will respond off of the sequence of returns. 1987 was a pre-election year. 1987, the Dow was up 30% prior to Black Monday. You had a melt up and then a crash. Okay, and then by the way, the Fed pivoted because the Fed was raising rates. Okay, so I think Greenspan came in. So I think my argument here is that not that necessarily we have an 87 style crash, but there is precedent in history to see big moves on the way up in a single year, followed by big shock moves on the way down, which would be a credit event, which then causes the Fed to say, "Wow, we really overdid it." And honestly, I think it's very clear they already did. They just can't admit it yet.
So, and the melt up you think is coming from the fiscal side, since we're in a situation.
So if you want to go watch the rest, you can. He kind of talks a little bit about like the stimulus to the banks, and he talks a little bit about the bears being after all the bad news that we've had, them being scared. Like, I don't know. There's a little bit of the shots fired, but for the most part, I also agree with Michael Guyad's thesis. It could be right. Like, we can't know for certain. That's kind of why I wait for these weekly closes of invalidation, because we just can't know until we actually get that weekly close. And it makes sense that we could, we are winding up for volatility, and we haven't had the close on the quarter, so I can't really say until that quarterly close comes. I will say that the forecast for intra-week just updated today on the Q Spectrum 2, and it's matching what we should be expecting for the trading spectrum and the decennial, which is saying that, hey, we're at a possible reversal point on all three things. The AI trading Q Spectrum 2, it basically looks for cycles and it auto selects them, and it makes a hybrid out of all of these cycles, all fast and slow. And it's basically saying we're bottoming around the first 4 days of April. This is mostly something that you have to take with every news cycle, and every day it changes throughout the week. So the certainty of that being correct is uncertain. So I can't really put a certainty on it. I'm just saying, hey, it's a window of time that we should be vigilant, and we should look at market structure to see if it breaks down. Any hint of lower closes on the week or on the day going to that monthly or quarterly close is definitely significant. That's what I'm basically saying. And the trading spectrum, which is formed for a formula for the best walk forward analysis cycle, that's the best cycle for the best walk forward analysis of what has come to be true. We're at an inflection point of reversal. And then also in the decennial basically takes time frame period, so it's a 10-year annual of those periods, and it creates a math cycle basically of what it expects in terms of direction but unknown magnitude. And it looks like we have a possible downturn event, and it could be here where he said correction in April, melt up afterwards, and then a credit event later in the year. And for the most part, it matches what Darius Dale has said. His most recent interview, he basically said that for someone who doesn't want to deal with the volatility, just be in treasuries. It makes sense. This is like high level stuff. Like to be able to prepare for something like this, to trade volatility this crazy. But I have no idea as to what's going to happen. That's why we're taking it weekly close by weekly close, monthly close by monthly close, and quarterly close by quarterly close. And with every close, we get more information, and in that, the price is able to move, and that information is in the price, and that market structure tells us as to the probability of future price movement. And with this kind of math forecast that we've seen, like both could be true. Both theses could be true, and that's why we got to be on DEFCON 1. Red alert, high alert, the next week or two, and anything can happen. Like we could have a melt up from here, but we need points of invalidation for either side for us to actually make a critical judgment or to be able to think critically about what we should do to monetize or position correctly. So thanks for watching. Talk soon.